Welcome to Property and Finance by Shore Financial, your go-to podcast for the latest insights and trends in the property and finance world. I'm Theo Chambers, CEO of Shore Financial, and together we'll explore market updates with experts in this field and provide practical tips to help you make informed decisions in the ever-changing landscape of property and finance. Please note that this information is of general nature only and has been prepared without taking into account your particular financial needs, circumstances, and objectives. While every effort has been made to ensure the accuracy of the information, it is not guaranteed. You should obtain professional advice before acting on any information shared in this podcast. Now let's dive into today's episode. All right, ladies and gentlemen, welcome to another episode of Property and Finance with Shore Financial. Today we have a favourite guest of ours, a repeat guest, Eliza Owens, a head of research at formerly CoreLogic, but which is now been rebranded to Cotality. Eliza, welcome back.
Great to be here. Thank you for having me.
So Eliza was last on our podcast September 2023. So been a while. A lot has happened since September 2023. I think our last rate rise was November. So we were still in the rising interest rate climate back then. Now it's a whole different landscape with a decreasing interest rate climate, you could say. Although what I'm more interested today to talk about, and instead of talking about the ongoing forecast about interest rates like it's been in the past sometimes, I want to talk about some of these amazing topics that I've seen you come to on the news, on the media, put forward and share. So we should start out off with a hot topic that I saw recently. I think it was in April that you shared about how some of the policies put forward by both governments around first home buyer incentives and initiatives to support first home buyers actually have an adverse effect on affordability, and that these aren't the best initiatives to actually help Australians enter the property market. We'll start with that one today. Why don't you share your views on that one? Because I think in a nutshell, you're saying something along the lines of that we need to see incomes rising faster than house prices, right?
Yeah, so the federal election was dominated by conversations about housing affordability. And one of the things that was really interesting is that both the Housing Minister Claire O'Neil and Michael Sukkar in opposition had argued that house prices probably should continue to rise, but at a more moderate pace. So incomes should be outpacing growth in housing values. The problem with that is that if you go with that as a starting point, it takes a long time for incomes to catch up to be in a place where housing is actually more affordable. So my argument was actually you probably could sustain modest value declines in Australia's property market, at least from a financial stability perspective. So one of the things that I looked at to argue this case was resales data. And in the December quarter of 2024, if you reduced all of the resale results across the board by 10%, Australians would still have made a median profit from selling their home of about $260,000. So it was an argument that price gains have been so strong that you can afford to cop a little bit of a decrease in home values. And there was other supporting evidence like the RBA suggesting that if home values declined 30%, then 90% of Australian mortgage holders would still be estimated to be in positive equity. So the value of their home being more than the outstanding debt. The main argument from the housing minister and the shadow minister at the time being that negative equity was the risk if we committed to bringing housing values down.
That would have been a very controversial point to put forward publicly, I imagine, because not many people like any suggestion of increasing a decrease in property prices, I should say, increasing the chances of a decrease in property prices. Was there much of a pushback on your comments on that one publicly?
So funnily enough, we talked about it internally and said, well, should we bother wading into this conversation? But I thought it was important that we did. And I was pleasantly surprised that most of the response was, I agree with you, but pragmatically, how do we do that? which I think is, and I don't
A
have
valid
the
question.
answers.
Yeah.
But it's a really good starting point as a nation to say, hey, maybe we can afford for home values to actually come down. And even homeowners, there's been surveys in some places to suggest that even homeowners would be comfortable with home values going down a little bit if it meant that they didn't have to help their kids into the housing market as much, It actually would cost the bank of mum and dad less if housing was more affordable for their kids.
So whilst you don't have the solutions for policies to ease house prices, one thing you're confident about is that current policies in place aren't going to solve that problem and if anything, make it worse, right? So supporting first home buyers with excess amounts of leverage and waiving mortgage insurance and all that type of things aren't ideal for affordability long term.
That's right. And I think most analysts are expecting that when, for example, the expansion of the first home guarantee kicks in from next year, it will probably have the effect of pushing values higher at the low end of the market, which is obviously good in the short term for the industry and for first home buyers who can take advantage of that scheme, but it does present longer term challenges down the line.
So another thing I wanted to talk about today, which was I think probably also around April or May, I saw you on the news sharing, was how rent now in, I think it was 87 suburbs of Sydney, rent now is more expensive than mortgage repayments in 87 suburbs. Is that right? What was the data on that? Because that's very interesting.
Yeah, so this was analysis that we had done with some partners at Eubank. And it was basically looking at the state of the rental market, where rents are up over 30% since the start of the pandemic nationally, in the context of declining interest rates in 2025. So we did a quick snapshot of where rents were more expensive than a hypothetical mortgage payment on the same property. We just used the median dwelling in the market.
Sorry, can I ask a question on that, Eliza? What is a hypothetical mortgage repayment? Was that calculation on like 80%?
Yeah.
80% LVR?
Yes. So we're assuming a 20% deposit, current average mortgage rates for owner occupiers based on a new home loan versus the median rent valuation.
Okay. Yep. That's a fair assumption.
Yeah. So we looked at that just sort of straight up for different markets across Sydney. It wasn't quite 87. That was a slightly different analysis, and I can talk to that as well. But what we found is that there were about 10 markets, each of them unit markets, perhaps unsurprisingly, where that rent was more expensive than a mortgage. Some of these you'd expect. They were some of the cheaper pockets of Western Sydney, so Mount Druitt, Fairfield, Harris Park. But some of them were also inner city markets, like Ultimo, for example.
Would they be markets you'd most likely have not seen price growth for the past 5 years, property price growth?
That's a part of it. It's the fact that property values are subdued, but it's also the fact that rental demand is high. So that's your common characteristic of where rents are potentially going to be higher than the mortgage payment, is that it's a either low socioeconomic area, so there just is more rental demand because people can't get into the purchasing market, or it might be a really transient area, right? You think Ultimo, you think you get a lot of international students, or people who are only demanding housing for a relatively short period of time, and therefore rental is more popular for them.
Because you mentioned units as the main one, and units definitely the past 5 years haven't performed as well as houses. So I imagine there's been increases on the rent, but not increases on the property values, which is probably helping to sort of equate to that problem.
Absolutely. And it's only going to be further assisted by the reduction in mortgage rates over the course of 2025. I know you didn't want to get too much into predictions on interest rates, but given the fact we've already had 2 rate cuts, this analysis was only pricing in the Feb rate cut because of when we released it. But even if property prices rise over the course of the year, our analysis suggests that the gap between mortgage and rents nationally is probably still going to close because we anticipate that rents will kind of stabilize rather than fall as mortgage costs come down.
Well, you've brought it up now, so we may as well talk about it. I was planning on talking about it at some stage in this podcast, but I didn't want it to be our first topic, which has generally been the case in the past with some of our guest speakers. So, interest rates. So, 8th of July is the next RBA meeting, which is coming up. Last week, so depending when this podcast is downloaded or listened to, as of sort of mid-June, let's say, there was on the ASX rate tracker, there was an 89% chance of a rate cut predicted on the 8th of July. Like you've already touched on, we've had 2 rate cuts already. People are talking about 3 or 4 in total for the year, or maybe 4 or 5, so potentially another 2 to 3. However, there was something that came out over the weekend which sort of suggested that might be a bit of a bullish assumption, that we're expecting an 89% chance of rate cut. That may be a bit too ambitious as such. And I understand probably why, because everyone looked at the trim mean inflation, and the trimmed mean inflation other way around. Everyone looked at the headline inflation, and whilst the headline inflation stayed at 2.4, the trimmed mean inflation actually increased slightly for the most recent month of May. Mm-hmm. That is the monthly indicator, so not the quarterly data, which is what the RBA makes a decision upon. But I guess an increase in the trim mean, being the one the RBA is more focused on, is a little bit of a concern, and it is the ABS record. So that is something that's somewhat changing the landscape a little bit. What's Cotality's view on the interest rates ahead?
So we would imagine the RBA will be putting more weight on the quarterly data. And the quarterly data, at least for the March quarter, suggested that trim mean was sitting within the 2 to 3% range. The major banks are also forecasting 2 more. The median expectation, rather, of the big 4 is 2 more rate cuts over the course of this year. But obviously, the big bank rate forecasts have a little bit more rigidity than what we see in the ASX tracker. It's a little bit up in the air, but based on the big 4 forecasts, it seemed as though the next rate cut could actually be in August. So the median expectation would be for 2 more this year, finishing the year at 3.35%, which obviously would have a potential upside for the housing market with allowing more access to finance. And I think that's where the assumption is coming from for some modest price growth over 2025, despite these ongoing headwinds of kind of economic uncertainty and housing affordability weighing on demand.
Yeah, just the increase in affordability naturally. There's 2 sides to it, right? There's one, like you've touched on, the ability to get finance approved is sort of increases, your borrowing power increases as rates come down, and just naturally affordability with your repayments, because they're 2 considerations at the same time. It's funny what you said just at the end there. It's so true that there's globally sort of economic issues and concern, and with the global economy and geopolitical concerns as well. And we're still seeing, equities post-Liberation Day at almost all-time highs. We're still seeing some level of unknown confidence. Sentiment has improved in the marketplace. I'm interested to see what the House's view, once again, is on your end with all the data. But on our end, we're seeing more confidence, definitely an increase in confidence, and definitely an increase in sentiment. However, a bit of a lack of momentum in actually transacting. So people are still a little bit sheepish when making an offer on a property. There's still a decent gap between vendors' expectations, so sellers' expectations, and buyers, what they're willing to pay. And in most marketplaces that we operate across Sydney, we're seeing a decent amount of houses being passed in or properties being pulled from the market because they're just not getting the prices they want. What's the data on your end sort of suggesting on that note?
Yeah, I think it really reflects that picture. So generally what we observed with April between Trump tariff turmoil, the extended kind of super break between Anzac Day and Easter, the upcoming federal election, which again was very housing focused, is that it introduced a lot of uncertainty. And where you get uncertainty, you tend to get a reduction in sales and listings activity. Through April, we've seen record highs globally in things like the Trade Policy Uncertainty Index, Economic Uncertainty Index, and overall Uncertainty Index. And that's not good for big housing purchases and big financial commitments. However, the further we get from April, I think the more we can expect that gradual confidence to come back to the market. There were some big jumps between April and May in Australia's Consumer Sentiment Index. In June, we saw a little bit of a nudging higher, just 0.5%. But I think what it all translates to is just a little bit more hesitancy in buying and selling. On balance, we're still seeing more sales than new listings coming to market, and that's what's driving modest increases. But at a national level, the monthly gains in housing values that we've seen through the start of the year have averaged about 0.4%. And that's a little bit more subdued than what we saw the last time we were catching up, when the market was recovering from a bit of a decline and monthly values were rising about 0.9%. So it's ticking along. But I think with all the uncertainties and which are gradually turning into certainties as we see the outcome of trade negotiations, it's just kind of a more subdued upswing, especially in the context of rate reductions, which is kind of interesting.
Can we just go back there? Sorry, Eliza, you said something you touched on, which I'd like to open up a bit further. The listing volumes versus sales volumes, right? So I believe the 5-year average of listing volumes, I'm not sure if this was nationwide, I think it was, nationwide was about 15% off the 5-year average. And then how does that compare to actual sort of sales volumes of the sell-through rate of these listings and whatnot and clearance rates? What are you seeing on those data points?
Yeah, so at the moment, the latest data suggests about 35,000 new listings added to the market for the 4 weeks ending 8th of June. So that is about 4% below the historic 5-year average. In terms of the sales volumes, the sales to new listings ratio is tracking at just over 1. So it's about 1.1 nationally. So that means for every new listing that comes to market, there's 1.1 sales, and that suggests depletion of total stock levels. And that, again, that's being reflected now. So we've got about 133,000 listings on the market in total across Australia, and that's about 2% lower than where it was last year, but it's 13% lower than the historic 5-year average. So it speaks to this ongoing kind of market undersupply. And then on top of that, you've got issues in the construction sector, which are creating another sort of form of undersupply. And that, in a way, is kind of, it's kept resilience in the market in terms of continued value increases.
Sorry, just to make you repeat one comment there. Did you say that data was for the 4-week period up until end of April, was it?
Sorry, that's for the 4-week period ending 8th of June. So this is the latest listings data that we have. But through April, there was a more notable dip between the sort of mid-April and the historic average.
Yeah, so how does that compare to, let's say, the calendar year to date or financial year to date, however you report listing volume? Is it because 5% doesn't seem that bad in terms of a decrease of 5% of listing volumes. Not too bad.
No, in the new listing space, it's not too bad. And aside from April, when there was a big drop off, new listings volumes have been tracking pretty close to historic averages. But because you've got sales volumes continually outpacing new listings, that puts a depletion on total stock levels. And that's where you get total stock levels sitting about 13% below their historic 5-year average. And it varies a bit by city, but it's really notable still in those markets like Brisbane, Adelaide, and Perth. Sydney year to date stock levels have actually been a little bit higher, so currently sitting about 5% above the historic average.
Okay, and what about clearance rates across Australia? What markets are you seeing performing better than others? What's the general trend there?
In clearance rates, the combined capital cities have shown a little bit of a decline for, again, the week ending 8th of June. We saw a little bit of a jump in response to rate reductions initially, but then that faded to about 61%. So at 61%, we're below the historic decade average, which is closer to 65% across the combined capitals. What's interesting is that there's been a pretty decent pickup in Melbourne's final clearance rate, and that was a market that was obviously a bit weaker over the past few years. Brisbane, I believe, has also held up pretty well over the past few weeks. But ultimately, I think the clearance rate reflects what we've seen in the broader market trend in capital growth, where it's holding up there, but it's not the kind of robust boom time levels that we might have seen in, say, 2021.
Interesting about the comment of Melbourne. The data is indicating a slight recovery because it's gone through a bit of a tough period. And there's a lot of people we've had on the podcast recently talking about Melbourne now. Recently being this year, the last few months, talking about Melbourne now being maybe an opportunistic market to purchase in, an investment, that is. So it's good that the data is supporting that theory.
Oh, absolutely. I mean, really, it was triggered by rate cuts, or at least it's the bounce back in Melbourne has coincided with the February rate cut. So where the city has been in decline really for the past couple of years, the quarterly results are showing a 1.2% uplift in the past 3 months. The clearance rate is looking a little bit stronger, and total supply levels are starting to look a little bit more contained as well. So I think there's definitely some signs of recovery in that market. From an investment perspective, it's probably still very challenging, to be honest, just because of the levies that have been introduced specifically for investment properties in the past few years. But it has been a bit of a first home buyer haven where, I guess, because of that reduced competition and lower property prices relative to other capital cities over the past few years, 1 in every 3 first home buyer loans secured across Australia is secured for a first home buyer purchase in Victoria.
Very interesting. That's a fun fact. I didn't know that one myself. So I guess moving on to something I want to review or reflect, I should say, upon in our last podcast, which once again definitely came to fruition. A comment of yours, a forecast as such, that definitely came to fruition was that we were going to see a bit of an easing, you said, in the construction sector, given that we saw back then, being late 2023, a decrease in the building approvals. So naturally that puts a subsequent decrease in construction volume. And we're definitely seeing it. We've got clients that now have a bit more of a range of options, you could say, to choose from when using a builder. And some, believe it or not, some trades within the overall build, like joinery, has come back down again because there's less demand, which is somewhat relieving, maybe not for the builders, but it's somewhat relieving for the mums and dads that want to do a renovation or build a home, right? So what's Cotality's view on that? What's the data sharing on that note?
Well, first of all, thanks for starting with one that I got right.
Yeah.
Yeah, look, there's definitely been some improvement in the construction activity indicators, especially the analysis that we do internally around the cost of building a residential home. So the annual change in construction costs has come down from a peak of about 12% in the calendar year 2022. It's now down to just 2.9% in the year
Wow.
March 25. Now, again, it's always important to make the distinction between a fall in growth in prices and the fall in prices themselves. Construction costs through our measure have not actually come down. It's just that the rate at which they're rising has come right down. When we dive into some of the data, we're seeing, again, the early stages of construction where prices have actually eased a little bit. So things like architectural consulting fees or grey blocks, which go down pretty early on the construction side. And as you say, it just comes down to the reduction in approvals. That means that in the first instance, you're going to get a reduction in new home starts. And so that's where we've seen a little bit of the capacity easing in the sector. As you say, still very challenging for builders, still a very challenging space overall with lots of reform, I think, to be done, but
Yeah, that's
early
for sure.
signs of improvement.
Yeah. Well, we've already shared it in the past, but to share it again, I think we saw in 2024 about a 30% decrease across Sydney councils in DA submissions, 30% on average. So definitely a reduction. And yeah, it's becoming very challenging. We've also had some guest speakers in the past share their views on how developers, it's hard to make feasibility stack, especially in Sydney, because the cost of building some of these units just aren't. The price they can sell them at isn't sufficient enough for the cost of delivering them, right? So, with big slowdown in the supply of new units, especially actually Melbourne was the one that I was shocked about. Whilst we're seeing a big supply of new developments historically in Melbourne, in recent years, it's really dried up.
Yeah, and that's the risk for Melbourne. It's obviously very good from an affordability perspective at the moment, but if that price signal to developers is to stop developing, eventually that will have the impact of tightening supply. And that's going to be a challenge that, the state's going to have to work through in the future. They are trying things, obviously, with pockets of upzoning, but I guess there's more to do in terms of the feasibility that we need to see before new housing is delivered.
Yeah, well, one thing that we spoke about in this podcast in the past, which is definitely worth highlighting, is that I don't feel, if we look at investors that buy some of these brand new units as investment properties, and how in the past leading up to an election, we've seen debate on whether maybe getting rid of negative gearing or capital gains tax discounts would support a more affordable landscape for first home buyers and whatnot, meaning that it might ease house price growth. But I don't know how taxing housing more, because that's essentially what happens if you abolish negative gearing and capital gains tax discounts. I don't know how taxing housing more will equate to a decrease in property prices. Quite the opposite, because it'll become more expensive to own. And the same argument goes for the cost of these developers, in the cost they pay, or the overall fees and taxes and levies they pay in building these brand new units. I think that's something that should be reviewed. I've heard in the past up to 40% of the cost of a brand new unit is taxes, levies, and various fees to council and state government to get these things out of the ground. And if we want to increase supply, maybe some of these policies need to be reviewed.
Yeah, I think in terms of increased taxes and charges for investors and the impact on property price, it kind of comes back to this fundamental economic view that if you want to reduce the price of something, you can increase supply, but you can also reduce demand. And I think the idea behind increased levies for investors is to make it more expensive to own excess housing. Therefore, if you tax it, it gets relinquished. And I think we kind of are seeing the short-term benefits of that from a price perspective. But it's also, like you say, it creates longer term challenges. Like, how do you keep incentivizing the supply of new property? How do you keep that going once you've had that short term sell off of investment properties? I don't know the answer. I think you can't say that developers are the answer if you're at the same time going to put more taxes and charges on developers. So maybe it needs to be a bigger step up in government housing to fill that void in supply. But it's a challenge, I think, that the Victorian government might have to grapple with sooner rather than later.
Well, it was a bipartisan issue in the recent election and federal budget with the coalition, what they put forward as well, that both parties agreed not to touch these taxes around investment properties, negative gearing and capital gains tax exemptions. So that was reassuring for the landscape ahead, at least for investors. Maybe not the news that first home buyers wanted to see, because an easing would help them. You touched on something there, it just wasn't actually across what you were referring to. Levies or taxes associated with excessive housing, did you say?
Yeah, so it's the same concept of, like, if you reduce negative gearing or capital gains tax concessions, you're making it more expensive to own investment property. Maybe excess housing is not the right term.
Yeah, okay.
But to own an investment property, or like a property that you don't need for living in.
Yeah. Okay. Well, yeah, it's interesting times at the moment, because there's both sides of this issue where, the rent's going through the roof because of the lack of supply of investment properties for tenants to rent out, as in landlords aren't finding it appealing to buy an investment property, especially in Sydney. Other markets are a bit more attractive for investors, like Brisbane and Melbourne, for example, which is probably then linked to that higher clearance rates that you referred to in both those markets. But yeah, in Sydney, it's just not stacking. We're seeing a lot of people in our database and a lot of people in our real estate partners, rent rolls, landlords, that is, and investors sell their investment properties locally just because the numbers aren't making sense, right? Some of these properties are getting 1% to 2% gross yield. And even if it's negatively geared and they've got an attractive income to offset some of that gearing loss, it's only a win if the property's appreciating in value, right? And to our point earlier, some of these properties, units in particular, haven't moved in years. I've got some clients in our database that have bought brand new properties 10 years ago, and it's the same price they paid. And if it's been negatively geared that entire time, well, geez, that's a significant cost to wear without growth, right? So it's a balancing act, that's for sure.
Yes, and that's a particularly challenging condition, because these are buyers' markets where no one wants to buy. It's not as if the demand shortfall is made up for by first home buyers in the case of a lot of off-the-plan unit developments, the high density that we saw across Parramatta, parts of the city. Like you say, prices have just stagnated, and even though they are affordable, it's not like first home buyers are the ones who are going to come in and buy those kinds of properties. So it unfortunately turns out to be a little bit of a loss for everyone.
Yeah. So I guess somewhat related to that point, I believe your forecast back in 23 was that the rental market growth will slow, still rise, but at a lower rate. I think we saw that because whilst we said that in 87 suburbs or thereabouts, depending on what data you're looking at, in many suburbs there's been rent has now outpaced mortgage repayments, or the rental payments is higher than the mortgage repayments. That's purely off the back of rates coming down, but the actual price growth in rent itself has eased. Has that been the case?
It has. So annual growth in house rents across Australia is down to 3.5% in the year to May 25. That's down from a height of about 10%, 11% in the 12 months to October 21. So annual rent growth.
So you were right.
Yes. And the same in units. So we've gone from about 14% peak annual rent growth to about 3.5% again in the year to May.
So, and that's off the back of, I guess, excessive growth, right? 10% or 11%, I think you mentioned, that is not sustainable growth in rental prices, and it needed to ease, right?
Yeah, it's affordability constraints. So renters themselves aren't at an income level or income growth rate where they can keep putting more and more money towards their rental costs. There's also other demand side factors like net overseas migration has really normalized since 2022 when we had that brief period of, post-pandemic catch up. And a lot of overseas arrivals are renters when they first get here. So if your net overseas migration is going down, which it is, your rents are likely going to go down as well. And the other piece is household size and household formation in the rental market. So there is some data, it's a bit lagged now, but there's some data that's been put out by the RBA suggesting that more people are living together, more share houses being formed, and that helps to contain rent price growth as well.
People going back to co-living as such.
Yeah, and it's also a reflection, again, of affordability. Like, presumably people are share housing more to try and scale their rent costs.
Well, before I go on to sort of our final discussion being your crystal ball once again, I'd love to know, these points I've called out today are some of the things that I've seen you publicly share already. Is there any secret sauce that's going to come next in terms of some data or interesting things that you're seeing at Cotality that you'd like to share?
So the next thing I'll be looking out for is coming from the ABS, which is an update to population data. And this is going to be really important for us to follow the flows, not just from net overseas migration, which obviously has big implication for rent values, but the interstate flows I'm interested in. Last quarter, we saw Victoria creeping just back into positive interstate migration, which means more people coming into the state than leaving. And obviously that was after a big drop in population through the COVID period. So we'll be looking out for an improvement in Victoria's internal migration, maybe a bit of easing in some of the migration trend for Queensland and Western Australia, where growth rates in property values are still pretty strong, but they are a lot lower than what we were seeing this time last year.
So just to recap what you just said there for our listeners that aren't quite across some of those data points that you're alluding or referring to. So we've obviously seen record amounts of interstate migration into Western Australia and Queensland. However, did you say that the most recent quarter for Victoria was the first time we've seen a positive amount, like as in an increase in interstate migration since how long?
So just prior to COVID, the internal migration trend to Victoria was positive. And really, it is the past couple of quarters that we've seen in the data that it's just kind of crept back into positive territory. So
wow. But still, that's, even if it's a couple of quarters, we're talking 4 years of negative growth, essentially, a loss in interstate migration.
And deeply negative too. So if we go back to the December quarter of 2020, the net internal migration position for Victoria was minus 10,000 people. So the fact that it's now just getting back into a position where it's population growth mode from an interstate perspective based on the interstate moves, it's one of many indicators, I think, that we're starting to see a turn in the Victorian property market.
Yeah, and that's not just purely for affordability reasons then, right? Because I know Sydney's seeing a lot of migration to Queensland and WA because of affordability reasons, because there's a substantial difference in that disparity in median house prices in those markets. But Melbourne, it's not that significant of an improvement in affordability for those people to move, right? So it was almost like a lifestyle choice that all those people from Melbourne, the Melburnians are moving into state.
Well, I mean, it's important to keep in mind that across Western Australia, or in Perth and Brisbane and Adelaide, values have increased 70% or more since the start of the pandemic. In
Wow.
Melbourne, values have only increased about 13% since the start of the pandemic. So I think those internal migration moves could definitely be Victorians who maybe were thinking about a lifestyle change to the Sunshine State, thinking it's not really in my budget anymore. So affordability could be one of the influences, but no doubt other things like the fact that the further we get from the pandemic, the less inclination there is for people to leave as well.
Yeah, we're definitely seeing some people who have bought houses in Melbourne 4 or 5 years ago and seen little growth start to contemplate other markets. And there's a range of factors now sort of having an adverse effect to their affordability or feasibility, I should say, being able to actually do so. So, yeah, interesting times. So I guess since we've called out some fantastic things that you forecasted in 2023 to be so accurate and spot on.
Thank you. And thank you for not mentioning the ones that weren't so.
No, I'm not hiding anything. Actually, there was nothing that you said that was what we were hiding that was incorrect or false. I think you had the same view on interest rates. There wasn't an immediate need for ongoing increases at the time, and I think we had one more, and that was something that we both mutually agreed to at the time. So, no, I think on all fronts, you are right. I think we both maybe thought that rate cuts would come sooner than expected, but that was, I feel like, any economist, everybody thought that. So that one we won't worry about. So, crystal ball, the year ahead or the residual tail end of this year, let's say, what to expect? What's your crystal ball? What's your forecast?
So obviously interest rate reductions, we've got more expected over the course of 2025, and history tells us that means we'll probably see further increase in property prices. I guess just based on some of the early indicators we're seeing in the data at the moment, there is a suggestion that this won't be a massive upswing, that the property price increases we'd expect to see from interest rate cuts are going to be tempered by things like the fact that property values have already gone up so much. So affordability really presenting a challenge, particularly for the likes of Western Australia, Perth and South Australia that have already seen big increases, and of course Sydney, where property values are just so inherently high anyway.
Sorry, go on.
Oh, thanks. No, I was just going to say, I think that might mean we'll see outperformance still in more affordable markets, whereas usually you'd expect rate cuts to have the biggest impact at the high end of the market. We have seen a little bit of that in Sydney, but it's more in, I would say, speculative areas, so areas earmarked for new metro stations, like along the Metro West, North Strathfield, for example, having really strong growth. Areas earmarked for higher density. So it might be a more select, investor savvy kind of market that sees a stronger reaction to interest rate cuts, as well as some of the more affordable pockets like in regional Australia.
That's a good call out, because a lot of people just think that a decreasing interest rate environment will make prices rise in all markets. And yeah, there is it's upward pressure on property prices in a decreasing rate environment. But you're right, off the back of such a crazy growth period, that continuous growth is somewhat not sustainable in most market places, just purely from an affordability point of view. So it sounds like what you were sort of touching on there was that buyers will chase value, and the markets in which will perform, the speculative markets, as you said, I like that word, are probably where we're going to see sort of significant amounts of growth, because even as rates come down, let's say we land on a cash rate of early 3%, it's still historically about the median, or if anything, a bit higher.
Yeah.
So it's not really going to put too much upward pressure on prices.
Yeah, that's right. The pre-COVID decade average was about 2.5% for the cash rate. So we're still settling at a kind of higher interest rate environment. Of course, depending on how economic conditions play out, we could get further rate cuts. But those same economic uncertainties of reduced business activity that we get from some level of increased tariffs, for example, that could then have a negative impact for housing demand for some buyers as well. There is some optimism, though, for the first home buyer market. We do think with the expansion of the first home guarantee, reduction in mortgage rates, and high rent costs, this could create an environment where more people make the transition from renting to owning a home. So that's sort of one of the other outlook pieces, I guess, is for greater first home buyer activity in 2026 in particular.
Something you just called out there, which is it's good to highlight, that 10-year sort of average thereabouts of a 2.5% cash rate. It's funny, ironically, for 10 years pre-COVID, the RBA was trying to kickstart inflation. we had such a low level of CPI and inflation. It was hovering around 1.5%. So it was below that sort of 2 to 3% target they were aiming for. And then we had the opposite the past 5 years, trying to tackle inflation. Quite ironic.
Who knew all it would take was record low interest rates and peacetime fiscal stimulus to get inflation going again?
Yeah, and a global pandemic.
Yeah.
To sprinkle that on top.
Yeah.
All right, Eliza. Well, thank you so much for your time again today. I know you're a busy person. You've got people pulling you left, right, and centre for your words of wisdom and such. So I really appreciate that you've taken the time to share your views and Cotality's views with our listeners. So greatly appreciate your time and look forward to having you on our podcast again. We won't leave it for so long next time. We won't wait 18 months. Hopefully in 12 months we'll reflect on some of these points again.
Excellent. Thank you so much for having me. It was great to talk to you.
All right. Thanks, Eliza. Bye for now. Thank you for tuning into today's episode. We hope you found it valuable. If you enjoyed the conversation, don't forget to like, subscribe, and leave a review wherever you're listening. It helps us reach more people and keep delivering the content you care about. We'll be back soon with more insights and conversations. Until then, thanks for listening.